The legal structure of an entity, whether it be a corporation or an LLC, or if you start your own business and you're just a sole proprietor, can be completely different from how an entity is taxed. So our entities are LLCs from a legal point of view. That's a limited liability company, and they're very straightforward and easy to set up and manage. But with a LLC, you get to decide, do I want to be taxed like a partnership, or do I want to be taxed like a corporation? And all of our entities are taxed as corporations, and there's a couple reasons for that. The first is that's the only way you can become a REIT, is for the entities that qualify as REITs. We have to be corporations. Corporations, whether they're REITs or just or regular corporations, have a huge tax reporting advantage, which is one of the main reasons why we like that structure. Corporations and REITs report taxes on a 1099 div. It's a one-page, very simple, streamlined tax reporting form with just a few boxes. If you have an LLC that's taxed as a partnership, the tax reporting is very complicated. You get a K1, which could be multiple pages and schedules. It has a lot more boxes, and it creates a lot more complexity on your individual tax return. So the fact that we, both our short-term rentals and long-term rentals, whether they're taxed as a REIT or taxed as a regular corporation, both get to take advantage of a 1099 div. So we talked about some of the advantages of a 1099 div, but let's talk about the comparison between a 1099 div and a K1, because there are some nuances there. And in certain circumstances, but it depends a lot on the taxpayer's individual circumstances, a K1 could be beneficial. And the reason is tax losses. REITs and corporations are not allowed to pass losses on to their shareholders. Their losses are carried forward, and they get to offset gains in the future. So you still get to take advantage of them, but you cannot deduct losses in the current year. Now, if you have something that's taxed as a partnership, or if you own a property outright and you have losses, those losses may be able to be taken advantage of on your personal tax return, but it depends on a lot of complicated circumstances. You have to have other passive activities that have gains to offset, and it depends on some subtle classifications of different kinds of investments and your level of activity with them. So it is, not a given that you would be able to take advantage of those losses. And a lot of times, for most people, those losses just offset future gains, exact same situation as they do in a corporation or a REIT. So what is a REIT? A lot of people associate REIT with very large publicly traded real estate funds, but a REIT is really just a set of tax rules that apply to real estate ownership that meet a very set of certain criteria. And it arrived, all of our long-term rentals are REITs. And REITs have a few tax advantages. Again, we have to comply with some rules first. We have to have at least 100 shareholders. We have to have a certain percentage of our assets in real estate, which we do. All of our assets are pretty much in real estate. All of our income has to come from real estate, which we do because we're operating these as long-term rentals. And we have to distribute our income to our investors, which we do because that is our business plan. And as a result, we do get some tax advantages. So again, a REIT is a special type of corporation for tax purposes. And what we're allowed to do, unlike other corporations, is we are allowed to pass through all of the income to our investors. So instead of paying tax at a corporate level and then a different tax to our investors, we get to pass all of the income all the way through. Now, one of the biggest benefits is on capital gains. And we're going to hold our properties for a certain period of time. And when we sell them, we are actually allowed to pass capital gains to our investors. And as most people know, capital gains are taxed at a much lower rate than rental income and ordinary income, interest, earned income. Most of the other kinds of income out there are taxed at a much higher rate than capital gains. And we expect a lot of our overall returns from our investments to be in the form of capital gains. So the fact that we're allowed to do that, again, is a huge advantage of a REIT. There is one more thing. There were some special tax laws passed a few years ago that are in effect through 2025. and REITs get what it turns out to be a 20% discount on the income. So if you make $100, you're really only going to pay tax on $80. So that's something that we're certainly taking advantage of as long as that law is in effect. There is one more advantage of a REIT from a state tax point of view, and this helps a lot of people just from complexity. Because if you bought a property in another state, or you invested in an LLC in another state and you had income, you might have a filing requirement. You might have to pay income tax in that other state. With a REIT, all the taxes due are based on where you, the investor, live, where you file your taxes. So if you're in California and buy properties in all 49 other states, you don't have to worry about filing in those 49 other states. So just again, especially because it arrived, we encourage making diversified investments and investing across lots of properties. The fact that you don't have to worry about the state taxes takes away one of the big barriers of doing that otherwise. So vacation rentals are taxed in a slightly different way. They're taxed as corporations, not REITs. And the reason is that the REIT rules are, again, there's some very specific ones, and long-term rentals fit the box exactly. But short-term rentals, you're not just renting out the real estate. You're doing it on a short-term basis, which the IRS doesn't, with less than 30 days, it doesn't define that as a lease. It's more like a hotel transient stay, again, from an IRS point of view. Also, it's not just pure rent on the property. You're also bundling in some services, cleaning, utilities. So for all those reasons, a short-term rental does not fit the current requirements to be a REIT, so we have to tax those as a corporation. So as we've discussed, REITs allocate ordinary dividends to shareholders, and ordinary dividends are taxed at ordinary income rates. Now, we did talk about that through 2025, we do get a 20% discount on that, but in general terms, they are taxed at ordinary rates, which is your basic highest marginal tax rate. And the reason that is because there's no tax paid at the corporate level of a REIT. All of the tax is just allocated to investors. They pay at their own rates based on their income levels and the states that they're in. And this is in contrast to short-term rentals, where part of the tax is paid at the corporate level, and then part of the tax is paid as a qualified dividend, which is a lower rate. But when we add those two together, the corporate rate and the qualified dividend rate, it turns out to be the exact same as the ordinary dividend rate that comes from a REIT. So there was some legislation passed several years ago. It was called the Tax Cuts and Jobs Act, and it created some tax incentives. And these tax incentives were designed for most ordinary businesses. They took away some exemptions like healthcare and certain services, but it was meant to be an economic incentive. And they defined certain income as qualified. So if you had manufacturing and certain other businesses where you were creating something, the types of activities that the government wanted to incentivize, you got a 20% deduction on your income. And that was called anything they called qualified business income. And as part of that legislation, they included real estate, operating real estate. Those activities also counted as QBI, and specifically REITs. Any dividends from REITs count as QBI, which means they qualify for that 20% deduction. And we are certainly taking advantage of it, and we'll do that all the way through 2025 when the law is set to expire. So what is a capital gain? A capital gain is the gain on a sale of an investment asset that you have held for a certain period of time. If you've held it for less than a year, it's a short-term capital gain, and it's taxed just like ordinary income. If you hold it for longer than a year, it's a long-term capital gain, and there's some very preferential tax rates for that. It depends on your overall income, but they're generally top out at about 20%. And then people that are extremely high earners, there's a surcharge of 3.8%. There may also be some state tax implications, but in all cases, it is substantially lower than the rate at which ordinary income is taxed. So what is depreciation? It can be a little bit confusing, but it is a concept that exists in the accounting and tax world. And the concept is this: Assets that are put into use for business purposes or for income purposes are given a useful life. And the IRS has determined that a rental house has a useful life of 27 and a half years. So let's give an example. Say we bought a house for $300,000 and we said the land was worth $25,000 and the building was worth $275,000. That would mean that over the 27 and a half years, at least from an IRS point of view, the house would be worth zero. Now we all know that's not true, that houses last a lot longer, so we can use these rules to our advantage. What that means is every year we get a $10,000 deduction. It's like $10,000 of value of the house at least disappeared from an accounting point of view, and we get a tax deduction for that. So let's say we had $10,000 in net income for the year. Now we have this $10,000 depreciation expense, which didn't actually cost us any cash. We would end up having a taxable income of zero, which means that we wouldn't owe any income tax on the investment for that year. Now let's take that same example. Say we made $15,000 for the year and we had depreciation of 10. What would happen is we would pay tax on 5,000. Now, but we actually generated $15,000 of cash and we're going to distribute that to our investors. So what does that mean on the 1099? On your 1099, you're going to get $5,000 in ordinary dividends because that's the amount of taxable income we have. But we're also going to note that you have $10,000 and it's called a non-dividend distribution. And we're just noting that we gave you some of the money back from the investment, but there was absolutely no tax impact. It does not have to be reported on your tax return, doesn't result in any additional tax being paid. So let's go back to the example where we had the house that has a value of $275,000 for the building and $25,000 for the land. So we've paid a total of $300,000 for it. But depreciation, since it's 27 and a half years, we're going to get a $10,000 deduction each year for depreciation. So how is that taxed? Well, we do get a deduction each of the years we're operating the property. And that is reducing our ordinary dividends because it's reducing our rental income, maybe even resulting in no rental income. So we're getting a huge tax benefit from that depreciation every year we're operating the property. Now let's say we hold it 5 years and then we sell the property for $350,000. Now we paid $300,000 for the property, we sold it for $350,000. That's a capital gain of $50,000. Now we also have $50,000 of depreciation on the books. What happens to that? Well, there's a special box on the 1099 div it's called Depreciation Recapture. And that is currently taxed at a flat rate of 25%. Now that 25% rate is lower than the top ordinary dividend rate. So not only are we eventually paying a lower rate on that amount of money, but we're also getting a time value of money advantage because we're getting that deduction all along the way and we're only paying that 25% depreciation recapture at the very end. So we really win twice on it. All right, so what is a 1031 exchange? It's a special set of tax rules that the IRS has where if you sell an investment property and you exchange that into another investment property, which is considered a like-kind exchange, you're allowed to defer your tax. Now, there's a lot of rules around it in terms of timing. And one of the other main rules is that the person that actually or the entity that owns the real estate on title has to be the exact same before and after the exchange. So a lot of people ask, can you do an exchange into shares of Arrived? And the answer is unfortunately not, because it's the name of our LLC that's actually on title. And the IRS has also just ruled in general that shares of a REIT do not constitute a like-kind exchange when someone is selling property.